Hey guys, so a bit of a contradictory statement today. I want to walk you through the reason why I feel debt is actually an asset rather than a liability. Different way of thinking about it. Fundamentally, it is still a liability, but can also be viewed as an asset. So I want to take you back to where it all started for me. This is an extract from a book called Rich Dad, Poor Dad by Robert Kiyosaki. If you haven't read it, it's fundamental to understanding about wealth generation and how your day job is costing you money over time rather than getting into assets that are going to build you an asset base over time, and really fundamental. So definitely check it out. I'm going to start with a graph that's been published here, broken down into four main areas. The first one is income, expenses, assets, and liability. And we're going to go through the two classes that are indicated. So the first one on the left here is the middle class. And all this is demonstrating to us is, so we've got our day job, that's going to determine into a salary, where we're putting that salary or income into our liabilities, which is things like mortgage, car loans, credit cards, school loans, and then they feed into expenses. So we have taxes as expenses, mortgage repayments as expenses, car payments as expenses, credit cards, school loans, they're all payments. So they're all expenses going out. And then we just repeat that cycle, right? Salary comes in, liabilities, we have to pay expenses towards those, and the circle just goes round and round and round and round and round. When we go to the rich side of things, all this is, clearly saying is, don't rely on that job and that salary. Have assets that are going to generate you income. So we've got assets now, which is real estate, stocks, bonds, notes, intellectual property. That's all going to feed into income, where we've got our rental income coming in, our dividends, our interest, our royalties. There are some expenses that we have to pay along the journey in terms of taxes and mortgage repayments for things like real estate. And in our liabilities, we've still got our mortgage, our consumer loans, and our credit cards. So we've still got those things, still need them to fundamentally live. But all this is sort of clearly demonstrating is, stop having just your job as a salary of source of income and feeding into your expenses. Have assets that can feed you a source of income and allow them to pay your expenses and liabilities. So this was light bulb moment stuff for me, and sort of understanding about wealth generation and everything else like that. There's just a few things that I want to break down on these charts, as break them down further as sort of taking a property mindset. So, let's take away the wealth generation mindset now and sort of think about property as an asset class by itself. So if we think about that on the rich side, we've got things here like our real estate, our mortgage, and our mortgage repayments, and our rental income for income side of things. So we've got something in each of the four categories here relating to property. The first one is obviously the rental income is an income. 100%. I completely agree with that. That should be on your income side of things. Expenses is mortgage repayments. Now, obviously this is an expense, but I feel this should be broken down into two portions. So depending if you are paying principal and interest or interest only. So if you are paying just interest only, the interest portion is an expense. That is going out. That is what is costing us to hold on to these assets. However, if you are paying a principal portion as well, I'd consider that as an asset. You're feeding that back into reducing your loan, and that's going to be an asset. You're creating equity by doing that over time. So I'd fundamentally say that is an asset. Only just the fundamental first disagreement I'd see there is in the expenses side of things. So mortgage repayments, breaking it down into principal and interest, and what side of the fence they sit on. Then when we get to assets and liabilities on our balance sheet, obviously, real estate or property is an asset. However, again, I'd break these down into two things. There's 1,000 different things that break up into a property, but if you can break it down to two simple things, the first one is the land component, and the second one is the building component. So if you think about land and buildings, there's an old adage of land increases in values while buildings depreciate in value. So when you think about a building, it's made up of materials. Over time, those materials are going to get weathered. They're going to decrease in value. And fundamentally, if you hold on to it long enough, you're probably going to have to knock it down and rebuild anyway. So materials do depreciate in value over time. And so the building side of things on that asset, I'd actually consider as a liability. It is something that you're going to have to amend or fix or do maintenance on down the line. So I'd actually break it up into those two things as a liability. The second thing is the land component. Now, if you've got scarcity within your land, it's unique. There's not an over surplus of land available in the area. That should increase in value over time. And so fundamentally, I leave that on the asset side of things. That's a true asset. Now, the argument for that is the building is what generates the rental income, which is considered an asset anyway. But when you break it down into sort of that long-term 30-year view, which is my fundamental, that's what we're talking about there. Now, the last category is this liability side of things, and we've got our mortgage here. Now, fundamentally, yes, a mortgage is a debt that you owe. You're going to have to pay that over time. If you sell your property, which you've got complete control over, you're going to have to give a portion of that back to whoever you've got your debt with to pay off that debt, right? Makes sense fundamentally. However, there's something called inflation, and inflation is what switches my mind from thinking it's actually an asset. So if you don't know what inflation is, it's essentially the value of money decreasing over time. So let's say that the target for inflation is 3% on average. Let's just use that as a rule of thumb moving forward. So what that fundamentally means is your $100 today is going to be worth $3 less next year if we've got a 3% inflation, right? So what you can buy for $100 today, you can only buy $97 of next year. So that $3 is coming off the total, and you can only afford to get $97 of it next year. So if you just sat $100 in the bank, that would decrease over time, and you're actually losing out. And this is where people say that inflation is the way the government steals from you over time without you noticing. And again, another commonly said thing. So if you think about debt in that format as just a number that you owe to a bank. But you've got expenses covered in terms of mortgage repayments. Yes, fundamentally that makes sense. But the debt side of things and the mortgage side of things, well, it's actually money that the bank is waiting for you to give back to them. They can't do anything else with it, right? I mean, they've got their money that they can go and invest and fundamentally use from that side, but they're waiting for you to pay that back. And so it's on them, right? And if you think about inflation, well, if that money's on them, you're using that money to leverage to get into assets that's going to increase your asset base. That debt is theirs, and the money that's getting inflated away over time is what's going to decrease that value of that debt over time. So if you think about 30 years time on a 3% inflation rate, $1 million a year is going to decrease by $3,000. So if you had $1 million in debt this year, well, fundamentally it'd only be worth $997,000 next year. So that inflation is eating away at the debt over time, and that's what flips my switch in thinking that, well, yes, it's a liability in terms of something you owe, but at the same time, it's actually making you money because of inflation. So I'd consider it an asset. Now, to sort of clarify how this looks, I'm going to go through the Gameplans platform and walk you through some things. Now, if you haven't seen all these graphs and charts and assumptions and everything else like that, go and check out some previous videos. But the first thing I want to walk you through is our manually entered spends. Now, what this does is factor in all your spends over all your years. When you're entering in your information, you'll say, I want to go on a $10,000 holiday every year or whatever it might be. And then it increases with inflation over time. So, if you're going to go on a $10,000 holiday today, makes sense. But that same $10,000 holiday in 20 years' time is actually going to be worth a whole lot more. And you can see this with our holiday spends, right? So we start at about $10,000, and every time we go on a holiday, it's going to increase in value. And that's because inflation is having its impact on these dollars. A $10,000 holiday in 30 years' time will actually cost us $23,000 for the same money, for the same experience, for the same journey. Think about it that way, right? Dollar for dollar, $10,000 today, $23,000 in 30 years' time. Same with a car, right? If we've got $20,000 on a car today, in 3 years' time, it's actually going to cost us $21,000. In 13 years' time, it's going to cost us $28,000. In 20 years' time, it's going to cost us $38,000 for the same $20,000 car. So the value of money increases over time. And so your $10,000 today is not going to be worth $10,000 next year. Okay, hopefully that's clear. And then the other graph that I want to show you is our equity position. So this has three really key lines on it. The first one is our total market value. Now, if that compounds over time at 5%, you can see how these numbers start to rack up quite quickly. We go from a $1.7 million portfolio over 30 years to a $7.6 million portfolio, compounding at 5%. So that is clearly an asset that's clearly increasing in value over time. We've got our savings here, which is, our savings increasing over time. Now, this is actually getting inflated away. And you can see how these numbers, you think about $3.5 million today. Now, this is actually having savings contributed over time. But, if you think about $3.5 million today, it seems like a lot of money, but in 30 years time, it's going to get inflated away. It's not going to be as much. But if we look at our total debt levels around the $1.3 million mark, when you think about that at the same time too, yes, it's something you owe. It is a liability, but at the same time, it's a liability that's decreasing in value over time. So the portion, maybe let's frame it this way. The portion that's decreasing with your debt because of inflation should be considered as an asset, because it's actually increasing your wealth base over time. So your debt does get paid down over time, and you can essentially pay that down to zero over a 15-year time horizon using an offset strategy. However, at the same time, you've got inflation eating away at this debt, and so it's actually increasing your asset base. So yeah, fundamentally, I hope that makes sense, guys. You can break a property down into multiple different segments on the cash flow side of things and the balance sheet side of things. It's not just a simple real estate is an asset, mortgage is a liability, rental income is an income, and mortgage repayments is an expense. You can actually break them down into much further things and really identify what are the key things within a property that should go into your overall wealth strategy to build out your portfolio moving forward. All right. Hopefully that was valuable and didn't overcomplicate too many things, but yeah, I'll see you next time.